Hey there and welcome back. I'm Al Ibaroa. This is the Annuity Crash Course. There are a lot of people out there that have a lot of different options about the best way to make it through retirement without running out of money, when most investors just want to earn a reasonable rate of return without getting caught and punishing stock market volatility. I personally believe that there is no better way to attain peace of mind than by keeping the financial planning process as simple as possible by taking an income and growth-based approach. Annuities may not be for everybody, but their unique ability to offer principal protection so investors never lose money makes it easier than ever to live the dream of retirement in a way that you never thought possible. So let's talk about annuity contracts and things investors should be aware of before buying an annuity. Today I intend to get into some of the weeds here on some of the more technical concepts about annuities. So let's discuss surrender penalties, let's talk about free partial withdrawals, and let's discuss riders. Now, I'm going to start by translating the terms into more easy to understand language. So when one hears the word surrender as used in insurance speak, it translates into layman's terms to mean penalty. So surrender means penalty. Now I'll often use the words interchangeably, but in your mind think penalty because that's what it is. After all, it's an annuity contract, and if you, the user, change the terms of the contract, well, anytime one breaks a contract, there's usually a penalty that's associated with that, right? If you rent an apartment and you break the terms of the lease, there's a penalty. If you put money into a CD at the bank and you break the CD before it matures, there's likely a penalty. That's just the reality of buying an investment product that contains guarantees. If the insurance company is going to provide a guarantee, they need you to provide a guarantee that you're going to abide by the contract as well. It's not that the carrier is requiring you to lock up your dollars because they're this evil empire. It's that they've made all these promises to you and they'll fulfill those promises. But in order to fulfill those promises, they need to make their investment commitments. And that requires a time horizon. It takes time for them and you to make money. Should you change the terms, the insurance carrier can't be on the hook for losing money. An insurance company that loses money can make good on no guarantees that they're providing to their clients. They're willing to take their own business risks, they just can't be saddled with additional risks. I'm sure that makes sense. Now, when you put your money with the carrier, it's not locked up in this steel box that you're never going to have any access to. Investors have access through a structure commonly referred to as free partial withdrawals. Free means no penalty or no surrender charge. Partial withdrawal means you can take a percentage, but not all of the money out of the annuity on an annualized basis. That percentage is going to range in the neighborhood of 7 to 10%, and that's really carrier specific. In some cases, a carrier will allow a greater free partial withdrawal, but this may come with a rider charge. So I ask, is it really a free partial withdrawal if you've got to pay an extra fee for that? I don't think so. In most cases, when you hear or read the word rider, that typically can be translated to the word fee. So when you hear the word rider, I'd like you to think fee. Not in all cases, but in most cases. A rider is an add-on. It's something you're adding to the contract, and that is something that will typically have a fee that's associated with it. You see, it's important to understand what you're getting for that fee and make sure that there is value in paying that fee. There's more than one type of rider, but I'll specifically give mention to a popular one, which is the income rider. The income rider offers a lifetime income payment to the annuitant or a joint payout to the co-annuitant. The income is based on life expectancy, the date that the income is triggered, and how long the money has cooked. In other words, how long the carrier has had use of the funds to generate a return to fund that income. Income can be based on a single life or a joint life. Joint life is based on two people's life measure. As you might imagine, one person as a life measure will have a higher income payout versus two people as a life measure. The rationale here is pretty simple. It's that the carrier assumes longevity risk. If a person lives a long life, the income will prevail regardless of the investment performance. The onus is on the carrier, not the annuitant. The question is, do you need an income rider, and is it worth paying the rider fee? In my opinion, this is not simply a yes or no answer. To understand this, it's wise to do some math and look at it from both the carrier's perspective as well as yours. So assume a couple is age 65 and they have an annuity with an income rider that will start to distribute $6,500 a year per every $100,000 they've allocated to the contract. Let's also clarify that this is a joint income rider. That means the lifetime payout is based off of 2 lives. Therefore, as long as one of them survives, the income will also survive. By the way, it's very important to understand single income versus joint income. Now, let's get back to the distribution. Now, when people hear this for the first time, they may confuse that $6,500 distribution as a return. It is not a return. Let me repeat that. It is not a return of $6,500. It is a distribution of $6,500. So when an insurance company agrees to cash flow you that much money annually, here's what's actually happening. First, the carrier has had access to your capital to make money for themselves and potentially for you until the income rider was triggered. Second, the cash interest credits, if any, they're added to your account and the rider fee is subtracted from your balance. Third, once the income distribution begins, it looks something like this. Income credits, if any, are added to the balance. The income distribution, meaning your annual income, is sent to you, and the rider fee is debited from the cash balance. Eventually, if there is not enough interest credits to overcome that distribution that flows to you and the income rider fee to guarantee that cash flow, well, then the remaining cash balance burns to zero. However, the income prevails regardless. Now look at this from the insurance company's perspective for a moment. And I ask that you do this objectively to best understand why an income rider may or may not be right for you. The payout factor that a carrier uses is based on mortality. So assume a 65-year-old couple is receiving $6,500 per $100,000. Simple math first tells us that in 15.38 years, you basically have just gotten your money back. That's $100,000 divided by $6,500 or 15.38 years. If they begin taking income at age 65, that takes the couple to the age of 80 before the carrier has to reach into their pocket and make up any additional income required absent any investment returns. Let's say that mortality is 88. Take the difference from 80 to 88, that's 8 years. Let's multiply that by $6,500 and we get $52,000. What the carrier is on the hook for is that $52,000 if there's been no investment return to offset those distributions. To break even, the carrier has to generate a return of $52,000 for themselves on that initial $100,000 over a 23-year window. Now, a 23-year window is calculated from 65 to 88. So for the carrier, this is not unlikely to happen. I mean, this is not a huge undertaking. The odds are pretty easy for them to accomplish that. But where it gets tricky is that they have to deliver that return while providing the annual distribution and making money for themselves, all while contending with their own business risk. You as an individual may think you could do the same. And while this may be true, the real question to ask yourself is, what happens if you don't successfully do that? What happens if your retirement coincides with an extended period of stock market volatility or low interest rates? What happens if 88 is conservative and you live well into your 90s? Where will that income come from? For some, the answer is other investments. For others, there's not really a good answer. Furthermore, when most financial plans are built for clients, it's done on a 4% spend down. That's thought to be appropriate. Anything north of a 4% distribution tend to put enormous pressure on the portfolio and challenges its survivability, meaning you up the odds of running out of money in retirement if you're taking more than 4% out of your equity portfolio. So when considering adding an income rider, I suggest that it can provide 3 main advantages. Let's assume one has a $500,000 portfolio of stocks and fixed income. Let's assume a financial plan with a 4% spend down. How much would that generate? The answer is $20,000 per year. And even though 4% is a realistic figure, there's no guarantee that that portfolio will be able to generate that $20,000 in perpetuity because of stock market risks. So the calculation is derived as follows. We take $500,000 in a portfolio, we multiply it by 4%, and that's how you get your $20,000 per year calculation. Now, let's take the same $500,000 but allocate $200,000 of it into an annuity that has a lifetime income rider of 6.5%. With the first $300,000 in the stock market, let's assume you take 4%, which is $12,000. That's $300,000 times 4% equals $12,000. The remaining $200,000 has been allocated to the annuity, which is paying 6.5%, generating $13,000. Again, $200,000 times 6.5% is $13,000. So you're taking $12,000 from the risk portion of the portfolio and $13,000 from the annuity generated, and now you have $25,000 a year. That's $5,000 more dollars per year, or a 25% increase in annual income with no additional pressure to the portfolio. Another way to look at it is as follows. Say the goal is to pull $20,000 a year from that $500,000, but you're worried that you may be running out of money. The $200,000 allocation in the annuity generates $13,000. We've established that. This means to hit the target goal of $20,000, we need to draw just $7,000 from the $300,000 allocated to stocks and fixed income. That's the risk portion of the portfolio. $7,000 on a balance of $300,000 is only 2.3%. This puts far less pressure than the 4% on the $300,000 invested in stocks. Subsequently, that reduces the odds of running out of money. So to summarize, the income rider can benefit through three main categories. 1, longevity on the overall assets. 2, guaranteed income regardless of market conditions. And 3, an income booster to the annual spend down. It's a tool to reduce the burden of a 4% spend down, offering the likelihood of greater success. Now, not all income riders are created equal. Not all of them have the same annual rider expense. Remember, rider means fee. They do not all have the same cost. It's of the utmost importance that you understand what the income benefit base is and how it's calculated. This is something that we spend time educating our clients on, and we found that one-on-one conversations really help cement this. If you have additional questions, please reach out to my office and I or another member of my team will help you. And you can do so by calling 800-750-9898 or clicking the link below and set an appointment with our team. I look forward to speaking with you soon and helping you improve your future quality of life and retirement outcomes. Thank you.